Welcome to Value Added, the real estate podcast where we speak with the brightest minds in the world of real estate who provide, create, and realize value in an ever-changing market. If you're a real estate professional delivering value to your clients, an investor creating value not seen by others, or a busy professional who passively invests in real estate to grow the value of their hard-earned dollar, then you're in the right place. And now your host, Nick Walters.
Hey gang, welcome to another episode of Value Added, the real estate podcast. On this week's episode, we have Ron Riemer. Ron is a home lending officer with Citi Bank. He's been in the business since 2004 and has experienced many ups and downs in the residential lending space over that time, from the mid-2000s run up to the Great Recession of 2008, as well as Hurricane Sandy, to the global pandemic known as coronavirus that we are currently experiencing. So without further ado, let's get on with the show. Ron Riemer, welcome to the show. How are you?
Good. Thank you for having me.
Tell me a little bit about you and your career and kind of the path that it's taken leading up to this point where we are today.
Yeah, I've been in the business for 15 years, seeing the highs, the lows, the peaks of the valley, the low parts. Starting in '04, we obviously had a much different marketplace in banking right through to the financial crisis. And prior to the financial crisis, most of the mortgage industry was done on a broker model. Mortgage brokers were very prevalent in being able to shop mortgages around for customers to all the different various banks. And there was a lot of value in doing that. And then post financial crisis, a lot of banks closed. Banking changed going forward from there. Today, obviously, we've dealt with a lot of things since then. We've dealt with, 9/11. We've dealt with Hurricane Sandy. Now we're dealing with a pandemic. So we've seen a lot of things happen in the past 15 years or so. I think we know how to embrace these things and how to work through them. But, banks are all about risk appetite. Lending is all about that. So some lending environments will have appetites for more creative and riskier loans, and other markets will not. It will be more conservative. So there are different types of markets for different types of environments that we work through, and so they sort of have to mesh together. So right now we're seeing a rollback of a lot of exceptions, a lot of credit policies, and a tightening up of underwriting, and banks not willing to bend where they may have bent in the past.
Give us some similarities or some differences between 2008, 9, 10, in the early stages of this recession.
Yeah, I mean the recession was a housing crisis. That was very different in regards to clients at that time were over leveraged on properties, financing with minimal down payments or none at all, and actually getting money back from banks at closings and financing over 100%. Not verifying income and assets, doing stated income, stated asset loans, which a lot of banks provided. And, that caused a ripple effect in the housing market and a massive amount of foreclosures. New York City was somewhat shielded from that because we do have a tremendous amount of co-op properties, about 70%. Co-op boards, as you know, and most people in the business know, are more strict than the average bank in terms of down payment, credit score, actually verifying documents. Because of that, there weren't a lot of foreclosures in the city, especially in co-op. So the city recovered very quickly from that, Manhattan. Today, not as many foreclosures, but we could get there because clients are slowly, obviously, losing their jobs, and unemployment numbers are through the roof. The last financial crisis was more immediate from the banking point of view. Now it's a little more dragged out because we're seeing, obviously, the economy is still not open. People are losing jobs left and right. We obviously, the service industry, restaurants, small businesses are a big part of our economy, especially in New York City. I mean, every mom and pop shop on the street in the retail spaces are going to be in trouble. So that's not good for us. But that's going to take a little bit of a longer effect to be felt. I think so. The banking world is looking down the road to see how that's going to look, and it's not not looking so great. Some clients are going to be fine, if they apply for a mortgage. Some clients that apply today may not, be able to qualify. They may be self-employed and not be able to show income for this year or last year.
Have you experienced any different lending standards now versus 45 days ago?
Yeah, I mean, they're slowly making changes. Some of the different banks have made changes. They've increased credit score requirements. They've decreased loan to values or increased down payment requirements. So that is definitely tightened up, and doesn't mean the banks aren't lending. They're definitely lending, but it's gonna be tougher to get your maximum financing, 90% or more on a jumbo loan. That is, Fannie Mae, Freddie Mac, FHA, all the government-backed loans you're still able to secure financing at, similar levels. So you're seeing more rollbacks on jumbo portfolio money and the criteria that banks use to qualify a customer. That's most of our market in Manhattan because of our price points. But for most of the country, the guidelines are still very much there in terms of credit score requirements.
Ron, compare and contrast the last two bull markets we've been in, the mid 2000s leading up to the Great Recession, and this market we just concluded leading up to coronavirus.
I mean, it's completely night and day. 04, 05 was a market that it was very, very different. The guidelines that were set up at that point in time were mainly geared towards helping, self-employed borrowers that were not showing a lot of income on their net income. They're showing their gross income, and obviously self-employed borrowers have their advantages to write off and pay less in income taxes by showing a different net income. And the products then were more, if you had good credit being above 720, um, the banks did not require income and asset verification in terms of paper documents, tax returns, and bank statements. Um, so there were a lot of standards that were very different in terms of how to secure a mortgage. And it was actually good that we went through that, because the policies and procedures that are in place today needed to be in place and should have been in place before that, to safeguard the industry and the economy, because that was an economic recession because of the housing market. So that's something that I think the world would like to avoid again. And it's nice to have those safeguards in place today, where banks know if you have an inquiry in your credit, they're going to ask you if you establish new debt. They're going to know if you apply with another lender. They're going to know if you're shopping for a loan. They're going to know if you applied for forbearance. They're going to know those things. And I mean, even today, I have clients that come in that are self-employed and say, "Well, I have, enough equity in my home. Why do I need to verify income? Why can't I just get a loan because I have 50% equity in my home?" And those are like examples of products that used to be available before the recession that are today. It's all about showing the customer's ability to repay and to carry the payment and afford the payment. So that way the banks know that you're going to continue making that payment. And that's what it's all about today is income to debt ratio, or DTI as we refer to it. That's income ratio, and making sure they can meet the lending standards of 43% or less to be a qualified mortgage. Um, and uh, and that's pretty much it. That's the way the standards have been for the last, I guess, 12 years, since 2008.
Ron, in the context of business, what does value mean to you?
Yeah, I mean, for me, values is it's a simple thing. It's something I have always demonstrated is just responsiveness. It's amazing to me that just what clients need and expect are simple things. And I think a lot of people in our business, or even on your side or my side, real estate or on mortgage, just don't respond to clients and don't give proper expectations. And it's the old saying, don't overpromise and underdeliver. It's a simple thing. A customer calls you for a mortgage, they're applying for a good or service that they expect a certain expectation on, and what you're going to deliver, what's the rate, what's the documents, how long is it going to take. And I think it's just telling them the right thing and having a normal conversation. And I think if you do that and you respond and you're on top of your emails and and your phone and calling people back. It's that simple. Clients appreciate that, and when you do that for them, they'll refer you to their friends and family, and you'll get more business out of it. So I think that's, to me, that's value. I know it sounds simple, and old fashioned or old school, but those are the things that work. They've always worked. And then from there, it's obviously who you work for, right? So with the bank that you work for, is going to offer different products and rates to different clients, and that may work or may not work. And I think it's important that the deals that you do take in, you make sure it can work for the bank that you represent, and that goes along with expectations.
Take us through a past deal where significant value was provided to get it across the finish line.
Probably, my best one was last summer. I mean, there was a few of them. Last summer, we had some big changes in the mansion tax laws going into effect in New York City. I believe it went into effect at the end of June, um, and it started July 1st. So there was a massive push from clients to close on properties before that took effect. Um, so across the board, it was 1%. Today, it changes if it's 2 million, 3 million, and above. It's different percentages of mansion tax. So I had a transaction that was rather large, in the double digit above 10 million. So the mansion tax ramifications of that deal were also rather large if the deal didn't take place. And um, it was the same thing. It was expectations, gathering documents, sort of pre-flighting the request with the bank and the credit committee of the bank, and running it by them, and not assuming that it will get done, and saying, here's the customer, this is what they're looking to apply for, this is what they're looking to secure. Can we do this before they sign a contract? And we do a lot of that, pre-flighting and due diligence up front, so that way when the client does sign a contract, we can actually close. And that's a deal we turned around very quickly. And we closed from start to finish on a signed contract in a couple of weeks, which is very hard to do on a large deal, let alone any deal. So that was, sort of the wins, from that market, that saved the client hundreds of thousands of dollars, hundreds of thousands on closing costs on the mansion tax. And if he didn't have that savings, he wouldn't have bought the apartment. So the selling broker had a sale, and the listing and the buyer side broker obviously had a transaction, and they both happened to be represented by Douglas Elliman, which was also a nice little perk, um, since I did a lot of business with them and yourself. And those are nice little wins to have.
We're going to conclude this episode with the hard hitting questions. These are a series of questions that we ask every listener. What is your why?
It's not all about commission. That's part of it, but for me, there has to be sort of a driving force behind wanting to work so hard every single day, no matter what, which is what I'm about. And at the end of the day, sometimes, you'll get a call from a customer. I got one last week. They called me about a refi. It didn't make sense. Didn't have enough of the savings on the rate. And they just wanted to spend a few minutes with me just to thank me for walking them through the process, buying a home that was a fixer upper that they're able to put some money in, and they flipped it and sold it and made a few $100,000. And they're telling me, and it doesn't happen all the time, especially on my side of the business. And they said to me, like, we wouldn't have bought this home or made this money if it wasn't for you. And that's what it's about. You're getting people into homes. You're not just giving them mortgages, you're letting them own a home. They're gonna have a family, they're gonna have kids, and you're a part of that sort of dream of happening, that American dream, so to speak, that you get them into a home. And it has to be about that. There has to be some sort of sort of emotion behind the transaction, not just numbers and paperwork. So that it's nice to hear that from clients every once in a while.
Besides your alarm clock, what gets you out of bed every morning?
My 2-year-old. That's definitely her, and obviously making sure that I do what I can to provide for my family.
What is the last book you read which significantly impacted your life?
I'm not the biggest book reader, to be honest. New York Times, New York Post, CNBC on TV, watching the stock market, seeing what's going on in the world. watching the markets is important to me. It's not just watching what's going on with mortgage rates, it's what's going on in the economy, because what happens in the economy dictates what happens to mortgage rates. I read mostly on articles on seeing what's going on CNN Money, New York Times, Bloomberg, things like that. Haven't dove into a book in quite some time, to be honest.
How do you like to blow off steam?
I do like to get my runs in when I can. I like to go for runs in Central Park. Haven't had time. On top of having a 2-year-old, also have a pregnant wife, so I have to be mindful of. I also need to help her out, so she can also rest. So right now I'm going for strolls around 9 o'clock at night with my daughter, and that's my new thing. I'm putting her to bed outside on the quiet streets of Manhattan that we have in this time of day. So that's where I get to sort of mentally uh, digest what we did for the day and wake up and do it all over again.
How do you like to pay it forward?
Helping clients, helping my colleagues grow. And I don't think I've been a big ego guy in my life. So, people call me, pick my brain about this, that, or the other. And, charitable organizations, when we can. Obviously, those are all important. I've seen a lot of those things happen in my family and different organizations to contribute to. So, try not to take things for granted in life.
How can our listeners learn a little bit more about you?
Cell phone number, text me, call me anytime. You can social media, search me on LinkedIn, Facebook, Instagram. Pretty accessible, pretty responsive, as I said. That's important to me. And if they want to contact me, they'll find me.
Ron Riemer, that's a wrap. Thanks for adding your value today.
Thank you. Thanks, Nick. Take care.
Thanks for listening. If you enjoyed this episode, please make sure to leave a rating and a review, which will help us introduce the podcast to other listeners. Also, don't forget to subscribe to our YouTube channel, which will give you access to other episodes you may have missed. Have a great day, and we'll talk to you next week.